Hello traders, welcome to the section on market participants. First thing, sorry to sort of stop you in your tracks, but absolutely crucial that you stop this video now. If you haven't already done so, you go to stage 3 and you work your way from 3.1 onwards, and it will make sense. You need to complete the order flow section now. You've done task 4. So yeah, just stop the video now and then come back to this. It will all make sense. Go to 3.1, stop this video, press play, and you start task 5 there, because you've just finished task 4, which is your basic hypo building. I want you to introduce order flow into your hypo building, which will become task 5. And then come back here. Like I said, it will all make sense. Don't worry, it's all ordered in a way intentionally. There's no point me introducing all the new VWAPs to you now, then putting order flow in. It just makes no sense. Makes much more sense now that I've got you on the day sort of perspective, as in investors on the day horizon, typically local scalpers, HFTs, all those guys using basically the day VWAP. They're the ones going to be using order flow. So it makes sense, whilst I still have you doing the day VWAP, to look at order flow. And this will make sense, as I said, when you get to 3.1, and it'll also make sense as we continue through this video. So as always, I just want to sort of recap what we've done so far. But you're going to laugh, but I'm going to say the same thing over again, just in case someone got up for a couple of minutes and missed this part of the video. Go to 3.1, okay, order flow, and work your way from that video onwards, and it will make sense. And then come back here. So your task 5, which is the next one after you just finished task 4, is in 3.1. All right, so hopefully that should be clear. I'm going to assume that if you now continue watching this, you've finished all of stage 3. You're, pretty much, maybe not an order flow expert, but you understand order flow pretty well. You've developed a lot of hypos using order flow. So I'm going to go on that basis. So let's just recap then. What have we done so far? Well, this is it. We're in the final leg of the education. Obviously, your journey to becoming a consistent trader is really only just starting. Let's be honest, there's huge hurdles ahead that will come obviously as you go through the process of observation. As I said, screen time, a lot of that is still to come, but at the end of the day, at least it's going to be quality screen time. You're going to be looking at the right things. You've dropped all the junk. You're now going to be looking and developing your ability to obviously create hypotheses based on market orders, market generated transactions, which makes much more sense than anything that you may have done in the past, unless you've looked at this stuff before. I'm going to go on the assumption you haven't. But now you have, so you've got that in your arsenal, but there is just a little bit left now, and that's just putting this final piece together, very important piece. So again, let's just sort of remind ourselves what we've looked at. So we've looked at depth of market in huge detail, right? That was in the sorry, just let me get a thicker pen, in the foundation course. So we looked at depth of market in incredible detail, not to a point where we needed to be profitable on it. We don't need to. You can see that now. We've worked through the pro course. Would have been a waste of time for you. Waste of time is maybe not the right word. Of course, I do have certain advantages, it's clear, because I spent all that time watching order flow. But as I've said, if you can develop the 70 and 20, this stuff, you can almost put it to the side. So it could be argued that, if you're going to get strong at the 70 and the 20, as I keep saying, even me, having spent all those years, depth of market watching, etc., etc., you're going to basically bridge that gap pretty quickly if you become good at the 70-20. So look, don't worry about it too much. You've now got to the stage in the pro course where I think, I didn't want to obviously say it before, but now that you've seen it for yourself, how little use we're making of the depth of market at that level. We keep saying it, or I keep saying it Don't forget, if we're being technically correct, let's be fair to the depth of market and order flow. This is order flow. This is order flow. This is order flow. The whole market is order flow, right? Even if you're a huge fund, which we're going to talk about in a second, you're a big player, you're still using order flow, aren't you? As in, maybe not the depth of market, but your order flow will be on the depth of market, albeit you may not actually use order flow at that granular level to actually enter your transactions. You're typically you're going to leave your transactions to an investment bank to obviously execute for you, typically. But at the same time, to make your investment decisions, you're not going to be using microscopic things like footprint, order flow. That's going to be very specific types of plays. We're going to discuss all that. But the point is, I guess put another way, is you've done depth of market to, a very, very competent level, way more than enough to be able to be a value trader. So I hope you can see that. I know many guys doing this who haven't put in anywhere near the amount of time that I had you putting in on the depth of market. So don't worry too much that you haven't spent 2 years and done all the sitting and staring for 10 hours a day for 2, 3 years, 4 years like I did. Just not necessary, to be honest. Like I said, focus on the 70-20. So to conclude, we've done enough, more than enough. You've done the footprint. Obviously, you've just come back from stage 3 footprint. You looked at it. I obviously made it clear, and I think you'll agree with me now, why at one point I did used to use it quite heavily, but you get better. You find better ways of doing things, and I'm sure you agree. Cumulative delta is a great way of being efficient on one sort of, not maybe one screen. I mean, one screen's fine for one market, absolutely no problem. But I just mean in sort of efficiency in terms of real estate, right? And also I talked about obviously all the other benefits of using cumulative delta. So, the ability to see neutral positioning, which you can't see on a depth of market or footprint, the ability to see order flow over long periods of time and what sentiment is like without having to sit there and staring at footprint, and even worse, sitting and staring at the depth of market. So, it's your decision to make. I've obviously given you all the facts, and hopefully, you agree with me. I mean, I've said it in that section. If you want to continue looking at those things, do it. I'm not going to do it. I can't stop you. No right or wrong. Obviously, if you want to continue doing it, do it. But obviously, I've been quite honest and said, look, my journey with that stuff was long and obviously fruitful, but unnecessary anymore. So, discuss that in obviously this early part of stage 3 of cumulative delta a lot. And the reason I mention all that is because basically this is what we're now going to be focusing on, right? So we've done this section. We've done order flow. Obviously, we're using it. I just mean in terms of the learning, at least as far as the course goes. Learning will obviously continue for the next several years, lifetime. I'm still learning things when I watch cumulative delta and the market doing certain things. I've been watching cumulative delta for many years and I'm still learning. So I don't necessarily mean observation learning. I just mean in terms of what I wanted to deliver to you. So done. Okay. Intraday will come back. Actually, let's just tick this off. So intraday, the VWAP volume profile to some extent, we've pretty much covered it, right? You've obviously been watching the volume profile on the depth of market. You understand it. There's no point me showing it to you on like your day VWAP chart. I do look at it on there. It's the same way that I look at it on the depth of market. We already covered it in the foundation, really. So, that and that are very linked. So, you could almost, let's be honest, those two were pretty much covered together. VWAP, we obviously went through in incredible detail. Crucial, absolutely crucial. So, as far as I'm concerned, happy with that. Job done. Again, still learning all the time. Even I'm learning all the time, with the VWAP on the day. You've seen I look at it slightly differently, as in I've just got the outer bands. I don't necessarily look at it in granular detail, but that's through years of observation. I've got comfortable with measuring rhythm with my eye, but I had the stabilizers for a long time. So keep them on, and at some stage later in your career, when you feel comfortable, let it go. But believe me, the time that you have the 0.5, 1, 1.5, 2, you have them all on, you know, take advantage of that time. You're going to learn loads. And you'll know when the time's right, because you'll have done it 1,000, 2, 10,000 times. And eventually, it will just subconsciously, I can see that. I can see the rhythm there. Yep, I spotted that. Fine. Then if you want to get rid of it, get rid of it. If you want to keep it, keep it. I use them on the higher time frame VWAPs, as you're going to see. Up to you, you know. So important I mention that, because as I introduce higher time frame VWAPs now, we're going to have all the bands, 0.5, same as what you've been seeing on your day VWAP. So that's covered, all right? And then context, huge amount of work we've done on context in stage 1. Auction market theory, we've looked at acceptance and rhythm in great detail with the VWAP and obviously with the market conditions. Market profile, again, volume profile. We haven't necessarily looked at it on a standalone basis, but look, it's not something that I'm necessarily going to cover separately to market profile, because the way that I look at volume profile is on the weekly and the monthly. I kind of have it there, but I don't really make much use of it. I mean, it's just there, I eyeball it. Very similar way to how you're doing it on the depth of market, you know. So where you saw with obviously moving around the nodes, NODES as you call them. These are just nodes. So that's a node, and then that's a low node. It's called a LVN, low volume node. And then these are called HVNs, high volume nodes, all right? They're just given these names, who cares what they're called? End of the day, is volume or no volume? Who cares, right? Don't get bogged down in terminology. You know, you read the books, I hear so many people saying, do this when you see a high volume node, do this when you see a low volume node. It's all nonsense. At the end of the day, you know, you'll know as you observe the market, its behavior around low volume and high volume. That's why I had you on depth of market. You can see how it behaves. You know, mainly I'm using, obviously, as you see, composite profiles, because they give a much better sense of balance than the weekly and monthly. You know, as we sort of kind of put some examples and stuff, I might show you, oh, look, this is very roughly how I might look at volume profile. Sorry, this volume profile in terms of my context. But you've seen me build my context for the day, and you're gonna see me build my context using high time frame VWAPs, and you're gonna see I don't actually use this for my context. It's more I might just eyeball it as the market approaches. You know, some volume on my sort of weekly VWAP chart or my monthly VWAP chart. I'll just be aware of it, and I'll just notice that okay, there was some value building there in terms of volume, but really that's the extent of it. That's why I'm not going to do a section on it. It's pointless. And then VWAP I'm going to come back to, because that's essentially all that's left. That's what we're going to cover now. Fundamentals, I'm a bit undecided on this one, so you'll have to forgive me. I haven't actually decided if I'm even going to bother putting a section in. I don't use fundamentals. I strongly believe, and my trading shows it, proof's in the pudding, right? Anyone can say what they want. Fundamental, you hear it all. Fundamentals are priced in, fundamentals are this, fundamentals are that. Who cares? If the person's making money using fundamentals, it works. If the person's not making money using fundamentals, it doesn't work. I make money not using fundamentals on an intraday basis, right? That's the crucial element. Because what I've found is, I'm not saying ignore Fed announcements, ignore payrolls. Of course not. You know, on a Friday, payrolls, I'm going to be aware of it. I'm going to either have no positions on or be light positioning. But what I'm not going to do is sit here trying to guess what way the number's going to go. It's completely ludicrous. People say to me, you know, on a day basis, do you care about news? Of course not. I don't mean this in a patronizing way. I just mean, look, I always say, let's think logically. Let's just not take people's words for it willy-nilly. Don't even take my word for it. Let's have a logical think about this. you know, if you look at the volatility of news announcements as an individual release, it's all over the place, right? It's all over the place. The sort of standard deviation is so wide of news releases as an individual, it's all over the place. However, it makes sense, right? How is the fundamentals of a country built up over time? The picture becomes clearer as you get more information. You might get retail sales, you might get the jobs number. Obviously, retail sales will have an impact on the jobs number, will have an impact on GDP. GDP is obviously driven by various things, exports, imports, all sorts of factors, government spending, all these factors are being built up over time. No one report or even two reports really are really going to make that much difference. They're just going to be random. So to the extent of, I'm not saying I ignore it, but to me, the happy medium is, all right, I haven't got a clue. I haven't got a crystal ball. I don't know one single release or even two releases what's going to happen. Let me just avoid it to be 100% safe rather than do some sort of, rolling the dice of it. That's all I do. I just steer clear of it. But, if you're trading obviously a bit longer term, say holding for a week, holding for 3, 4, maybe even 4, 5 days, you need to be an expert at fundamentals. But obviously, that's not what I'm doing. I'm gonna be honest with you. If you're trading for 4, 5 days and you think you can get away with not knowing the fundamentals, in my opinion, you're kidding yourself. I hear all these swing traders and this and that, and FX saying, "Nah, I'm just gonna do this and not even look at the fundamentals." Completely crazy. You need to know the news. I can tell you for a fact, I know, obviously, having worked, an investment bank, and we used to have huge client orders coming in. Guys are positioning ahead of things like payroll a week in advance. It's huge amounts of money. Logistically, it's very difficult for them to move money around. The way that we do. They don't have MetaTrader 4, or even, to some extent, even some of the institutional platforms that we have, where you can just buy and sell electronically easily. No one's going to take that size, right? You got to realize, put stuff in context. We're little fish, which has its advantages. It means we can be nimble, we can be more active, and therefore we can employ leverage much more effectively than the bigger players. That's why for them, you know 5, 10, 15, 20% is an amazing year, because they're moving billions. They're not doing it in one go. You've got to understand that they don't wake up on a Friday morning and think, "Oh, it's payrolls in a couple of hours, let me just not trade over it or clear my position." No. If they don't want to be involved, asset rotation, if they don't want to be in stocks, for example, and they want to switch, maybe not 100% of the allocation, but they want to be underweight, as in they want to reduce some of their exposure to equities because there's a risky event coming up. They're doing this for days, right? And it's really important I mention this, because that's the type of flow on the day basis we need to be aware of. But because our holding period isn't that long, we don't necessarily need to know the fundamentals. So actually, I think I've pretty much just done the fundamentals there. There you go, fundamentals done. Because all I wanted to really do is do a separate video just saying what I just said. So I hope you don't think it's too cheeky, me just saying that's done. I really don't have anything else to say on that. Um, and I don't want anyone to think, "Oh, Envy doesn't know fundamentals, he's has no interest." Guys, I'll tell you, when I was in investment banking for a long period of time, my job was to know fundamentals inside out. I'm talking to the point of knowing the components of the inflation basket. All right, we're talking high level of sort of economic understanding of what is driving portfolios of huge investment managers, and obviously hedge funds, real money, so on and so forth. I had to know this. It was part of my job. I'm not in those investment horizons anymore. It makes no sense for me. So, if anyone wants to have a chat, an in-depth chat about the components of GDP and the releases and what I think the impact on the economy is going to be, fine. But I don't use it, okay, to make my decision on where I think crude oil is going, or where I think the E-mini is going, or you've seen me trade pound dollar. I can be in and out fairly quickly. I'm not going to use fundamentals. It makes no sense. But you might be thinking, hang on, why am I keep going on about fundamentals? The point is, I want you to know, right? You still need to know why I don't use them. There has to be reasoning. You often hear, let's be honest, I use the word a lot, but it's so relevant. Complete and utter garbage I hear talked about. Oh, the fundamentals are priced in, so it's all rubbish. At the end of the day, they may be priced in on a very short-term basis, but why? Why is that? Why are fundamentals not important on a short-term basis, but actually you need to understand they are on a longer-term basis? Well, for the reasons I've just mentioned, right? So I've just gone into in-depth and detail and said that on an individual basis, the standard deviation of individual economic releases is very wide. Next time someone tells you, oh, it's all priced in, don't worry about it, tell them to explain. What does that mean? I'm trying to give you the meat on the bones to why on a day it is priced in. And also, I mentioned it before, it's a very important point. Now that I've decided to basically do the fundamental section at the start of this section, is that if you think about it, investors are incredibly emotional on a short-term basis, right? It's obvious, adrenaline, this, that, whatever the sort of human traits are that make us quite sort of panicky on a very short-term basis, like fear of missing out, or fear of getting stopped, and these type of things. They're obviously important on longer term basis, but less so. Like I said, a lot of the big guys, they're entering over days and weeks, right? You're not sitting there worried about, oh my god, my stop loss, this, that, the stuff you see in retail. It's important, don't get me wrong, of course they're going to be aware of it, but that investment decision is being taken over many hours, many days, so the emotions are not as sort of intense as they are on the day. That's another reason that fundamentals take a bit of a back seat when it comes to, in fact, a complete back seat when it comes to the intraday, is because emotions are much more important, right? And you see that it's much more volatile on a sort of intraday basis, or volatile to some extent. I mean, obviously the market is volatile even on a sort of longer term horizon. It's very volatile, and you've seen that. I don't know if you follow pound dollar, you've seen it with the Brexit scenario, and obviously the virus and this and the elections, and there's been a lot of political risk, and it's driven it huge amounts. It's not just volatility, is probably the wrong word. People say spiky, and that's nonsense. Really, it's unexplained. That's what it is. So a lot of the volatility over periods of time, you can explain them, right? You can say political risk, event risk, or whatever it is. Things have happened, as we saw with the pound. Obviously, it was Brexit in 2008. It was obviously financial crisis, and elections, as we've seen in the US as well, can have major impacts. So a lot of the volatility can be explained. That's what I'm saying. On an intraday basis, it can't be explained by fundamentals. It can be explained more by, obviously, emotional behavior. So hopefully that gives you a good, really, really good idea of why I don't look at fundamentals on a sort of my time frame. Even if I'm holding for 3, 4, 5, 6 hours, 7 hours, up to a day, maybe even day and a half on the very rare occasion I do. Really, day over a day is pushing it, because overnight obviously you get new investors coming in and they will digest some of the fundamental news. But in a session, nah. So that's probably the best way of thinking about it. In one session, not really. Just be aware of obviously big releases. All right, fundamentals done. So I can tick that off. So really all that's left now, would you agree? So let's, that's done. That's done. That's done. That's done. And fundamentals we've pretty much covered now. So really the only thing left now is the higher time frame VWAPs, which leads us on perfectly. So we've pretty much covered 90% of this. We've just got, I say just, incredibly important, like incredibly important. High time frame VWAPs. But to understand those, we need to understand the market players. Now, what I'm going to do, if I just clear this, is if you think about it, I'm just going to very briefly describe um, in very basic terms why different players are incredibly important. Um, and in fact, I'll tell you what, let's go on to the next slide because I think it makes more sense to do it on the next slide because I've made a list basically of the major players. It's by no means an exhaustive list, but it's the major, pretty much all the major players. And let's do it there because I just want to show you, diagrammatically why looking at other investor perspectives, horizons is really important. So we've done this, obviously, as I said, you know where you are now. We're really in that final bit of the learning phase before your, multi-year, obviously, hopefully, before you get to the end of your sim period, it's not going to be longer than another, 5-6 months or however long, but, in terms of the learning, multi-year. So let's get on to the next slide. I'll see you on the next slide. Okay, so you can see here, I've got a list of players in the market, and I think it's important that I pause here and I actually talk a little bit about why this is so important. You see, what it is, if you think about it, a lot of the course, auction market theory, I think pretty much everyone can see that a market is a market is a market. And I think I've said that before. It's a market. Whether that's chocolates, phones, speakers, anything, A4 pads of paper, anything you can think of, baby clothes, nappies. I don't know why I'm saying that, but baby clothes, nappies, baby food, um, shampoo, whatever. My point is that I'm thinking of such a wider range of stuff, array of goods. We've seen there's a depth of market for all of that stuff. The thing is, right, let's think now what problems could occur in financial markets that we don't necessarily have in those markets. We already talked a lot about supply side dominance and, obviously why the market being so well, this infrastructure of the financial markets being so amazing. The fact that you have these electronic platforms, people can buy like that, the supply at every price column creates incredible competition. These are the guys, right, that you see sitting on all those columns. And all these guys are in the market with different perceptions of value. So if you think about it, right, the people placing market orders and to some extent the supply side in traded goods and services that are not financial markets, speculative or otherwise, because you do get hedges as and arbitrages actually in the market. So it's not only speculation. But my point is that, where you can't necessarily transact in a liquid electronic way. So, the markets we talked about previously, like bread, milk, cheese, loads of markets. If you think of those markets, right, let's say you and we go down to Tesco. I keep saying Tesco. If you're in the US or somewhere else in the world, Walmart, your local big supermarket or whatever, where you're buying food, Costco, whatever, doesn't matter. Even your local shop, right? If you go down to one of these shops and you and I are sitting there and we're thinking, oh, you want to buy some milk, or you want to buy some eggs, or you want to buy some cheese or whatever. Let's say eggs, right? And it's like $1 a carton of eggs, a few eggs, maybe 6 or 10 eggs, a pack of eggs, right? Could be £1, it could be $1, depending on where you live. I live in the UK, so let's say £1. Guys, you're really not going to argue that much over yourselves about how much that thing's worth, right? You buying it, you're going to consume it. Pretty much everyone agrees, all right, pack of eggs, £1. Most things, would you agree? That's the case. Even the supply side column is not going to be miles away in terms of different suppliers in the local area, etc., etc. And even to some extent, you could argue, oh, but in different countries, Envy, they have different. Yeah, but you're not going to go abroad and pick up a pack of eggs and bring it back. This is my point. The infrastructure issues are different, and that's what makes financial markets actually a lot harder to make money in, because they're so efficient. That price determination process is so globalized. You know, I've said it before, and I don't mean this patronizing way, but you have no idea basically of the sort of challenge that you face trying to make sense of this thing, because of coming back to this point about everyone can agree, pack of eggs, £1, yeah, whatever, £1, 5p here or there, everyone's buying it, consuming it, job done, whatever. The problem in financial markets, right, is that you've got all these different sets of players. So let's not talk about the names for the moment. We'll come to that in literally a couple of minutes. But imagine this is us buying eggs down here. Doesn't matter if it's day traders. Let's just call this consumers of eggs, right? Pretty much all consumers are going to fit into one category, right? The problem with financial markets is there isn't one category. There's people who might want to. Now I know eggs have a limited shelf life, which actually I've heard is much longer than what the best before date is. But the point is, you'll have consumers in this category say, no, I want to hold eggs for a month. I want to hold. These guys will say, nope, I want it for 2 months, and it's therefore my perception of value of eggs is different. No, I want to be able to sell this in 4 months, 5 months. I want to be able to sell this in 6 months. No, I'm going to hold this asset, be it eggs, cheese, milk, whatever. Forget about the fact that it's obviously got a finite life to it. It doesn't matter. It could be anything. It could be a toy. It could be whatever it is. These people have the intention of either selling it or buying it, i.e. doing the opposite, closing their transaction way down the line. I'm talking huge differences. And don't forget, because of I talked about this in stage one, the time that you and I take for granted. Amazon changes their prices, Tesco changes their prices once every few days. You got to remember that is a second. Like, forget a second, it's a millisecond in financial markets. You've seen the depth of market. It's value can change in an instant. You can have these stop runs that happen in an instant. You can go from one little pocket of value to another pocket of value in an instant. So almost what's happening in the real world in days is happening in like a millisecond sometimes on financial markets. Obviously, times the market can be happy and stay at value. I'm just saying it has the ability, even the propensity to do this, right? Does that happen in the real world? No, it doesn't. And that causes value proposition problems, because this thing can just move around from value to value in an instant, right? So you've got that problem to deal with. But more importantly, you've got different types of consumers, end users, even like further up the chain, people who are not necessarily end users of obviously financial products, but even just like speculators, basically big speculators who are just buying and selling essentially. And the perception of value, the spectrum, you just have to stop and acknowledge this thing, otherwise you're in big trouble. You just have to understand that this guy's perception of value is going to be wildly different to this guy's perception of value, even if they're buying in exactly the same moment, the same asset on the same day at the same moment. Think about it. Let's actually go through them. And you know what? I'm not going to obviously go through each one individually. I've said this before. There's stuff you can Google. You can Google it, right? There's no point. Basically, I'll go through them very briefly, right? Real money, I've talked about it here. Huge amounts of money. I mean, more money than you can imagine these guys have. Pension funds of huge amounts of people, at companies and etc., etc. Of you're talking huge amounts of money, sovereign wealth funds, which especially some of these guys in the Middle East, oil money that they have, huge amounts, fund of funds, endowments, absolutely huge. But the point is, their investment horizon is not a day, okay? It can be months, it can be years, right? These guys are entering the market within long investment horizons. Hedges as well. You get obviously short-term hedges, but you also get huge long-term hedges. So typically they have a business that deals in the underlying. So it could be oil producers who want certainty over the oil price. They are going to be transacting in the futures market, oil futures market, um, massively. All right. They want protection. They want certainty. You could even have corporates as well who want balance sheet certainty. They'll be using all sorts of products via investment banks, obviously purchasing maybe futures, maybe options, whatever it is. You got to remember this isn't only about futures. At the end of the day, if these guys are investing in the cash stock market, it's going to drive the futures market, right? At the end of the day, what is the underlying asset of the S&P 500 futures that I look at? It's the S&P 500 cash market. Even if these guys end up buying stocks in a different country, it's going to have impacts on global stock markets, right? Typically, it's more the US market that drives other markets, obviously because of the size of the US economy, etc. But look, we're going off the topic here slightly, but it's important that these guys are going to have a major impact. Hedges are going to have an impact more at. There are obviously a lot of hedging going on a short-term basis, but a lot of hedging going on a long-term basis. But do you see the problem? You can't really split them out. You've got hedgers whose perception of value might be, oh, I'm going to buy this contract or I'm going to do this, and I think that the fair value is 20 ticks away. Could have a hedger who thinks the fair value is $5-10 away, right? You're talking 500,000 ticks, two different worlds apart. How on earth do you bring those perceptions of value together? We're obviously going to try and do that using the VWAPs on higher time frame, lower time frame. But the point is, if this guy comes in the market when you're entering your rotation and the rhythm is the minus 2SD, and you want to buy it, if this guy is selling the market, you're going to get crushed, right? So you need to be aware of what these guys are doing, is my point. Asset managers, obviously, manage huge pools of investor funds, passive, active, whatever you want to call them. Huge, absolutely massive, having huge impacts on obviously the S&P 500 that we look at. So yeah, obviously if you want to learn more about them, you can Google them, but don't think I'm sitting. The point is, the reason why, and even if you look at hedge funds, right, I've put here the different types of strategies that hedge funds employ. So obviously things like global macro is much more long term. Some of these other ones are much more shorter term. You've got different types of strategy: long, short, stat arb, relative value. You can Google all of this stuff. My point is this: I'm not sitting there when I'm trading the S&P 500 thinking, oh, there's a global macro hedge fund that's just come in the market. There's someone doing stat arb. There's a relative value player in the market. I couldn't care less. This is why I don't want to get into the details. I know these strategies inside out. I know the players because obviously I spent a long time in investment banking and I had these guys as customers. I know them, but it's not going to help you. It might help my ego. Yeah, let me explain all these guys, and you might be thinking, wow, Envy knows all this stuff. No, I'm just going to confuse you, all right? At the end of the day, I'm trying to help you by actually not doing all that rubbish. It's pointless. All you need to know is that these guys have different perceptions of value. Because if you start thinking, oh, is this type of, I've heard this before so many times from people who come into obviously institutional trading, young guys. They're keen, they're eager, they want to know, oh, is it this type of investor? Is it an asset manager? Is it a hedger? Is it real money? I hear it all the time, honestly, wasting their time. They're completely looking at the wrong things. It doesn't matter. You'll see, does it, think about it. Does it really matter if you can tell, with the higher time frame VWAPs that I'm going to show you, that there's a huge investor coming into the market, right? And you're trying to get short because you've got your, in fact, let's look at this. So you've got your day VWAP, and you've got some context up here, maybe a CVA low, and you've got your rotational, and you think, yep, 2SD, right? Market conditions, what? Rotational, what's the rhythm? 2SD, 1SD, whatever it is. You're trying to get short, and your higher time frame, like these guys will typically be looking at monthly, quarterly VWAPs, right? And let's say you've got something like a big monthly VWAP coming in, or it could be a 1SD, and you've just got, some sort of rhythm building here. Guys, as this rhythm starts to take off, this order flow is going to be in here somewhere. Obviously, because the guy has to come and do his business on the day, right? He's going to come in, he's going to ring an investment bank or whoever, and say, look, I want you to fill this. I talked about it, the VWAP, get me VWAP execution, whatever. Guys, this guy's going to blow you out of the water, and that's why you need to know he's there. Does it really matter if it's a fund of fund, a sovereign wealth fund, an endowment, a pension fund, a hedger? I couldn't care less. This is my point. It's very dangerous, this type of thinking, where I keep seeing it, people saying, oh, I need to know who it is. I need to know who it is. Who cares? At the end of the day, whether this is a pension fund or a fund of fund or an asset manager or even a global macro hedge fund coming in, all I care about is this guy's about to blow me out the water. I'm not going to go short. I'm either going to wait, or I'm going to wait for the day to go imbalanced and me to build value above my CVA low, and then fine, I'll go with him. I'm going to go with him. That's my point. I don't care who he is. I just know that someone is there with big size to be done. This really brings me on to a really crucial point, and we're going to continue going down the list, but it's also, if you read the book, like I suggested, and you may have read this OTF, they talk a lot in institutional. If you go to a prop firm and you say, guys, OTF's in the market, it's really important to these guys. Basically, prop firms are obviously, typically day traders, locals, heavily involved when the market's ranging, basically. Maybe stopping people out. So what they'll be typically doing is, when it gets to the top, you've seen this, rotational markets, driving people down. They'll typically be trying to just have stop runs there. They'll come down here, stop run, and then go the other way. And that's your flat VWAP. Stop run, stop run. My point is, on this type of day, rotational days, where these guys are very active, HFTs are obviously very active. These guys, they're not active, right? And you got to think why. Why is that? Because of this. Because when these guys have flow to do, guys, it's going to cause the market to go imbalanced. I can tell you this right now. I talked about this in the oil example I gave in, was it task 5, when we had oil, and I said we went, forgive me if it was positive, but I think it was negative 30,000 on the delta. Typically it's more like 10, 15,000. That's these guys, selling huge amounts of contracts, causing delta to go hugely negative or positive, causing the market to go imbalanced. Why? Because they've got order flow, they've got business to get done. And what's their horizon? What's their view? I just said they might be going for targets of $5-10. guys, their targets are here. You better believe their order flow, they're pushing the market towards those areas. So if you're playing rotations, you're just going to get blown out of the water. Why do you think these guys, day traders, scalpers, locals basically, they're always on the lookout for increasing volatility, any sort of signs that the day might be going into a trend day? We talked about this, day types. We might be going imbalanced. What's the delta doing? Is the delta very strong? Guys, I'm always aware of it. Who's in the market? Not our fund of funds in the market, our sovereign wealth funds in them. Forget about all that. Honestly, if you want to know, Google it. You'll never know. You'll drive yourself crazy. Who knows if the 2000 contract order was this guy, this guy, this. They don't want you to know, right? And believe me, if they don't want you to know, you're never going to know. Okay? Money speaks. If you've got thousands of contracts in the market, and you go to your guy at the investment bank or whoever to execute for you, at the end of the day, as I've shown you, the investment banks themselves are employing, and I've put it here, HFT, algos, to get this order flow in. It's not even done in one go. I've mentioned to you before, they break it up into so many pieces. Throughout the day, you just won't know, okay? But what they can't hide is the intent. Because at the end of the day, and I mentioned this before, this is why market orders are so important. At the end of the day, if you've got, say, 10,000 contracts to be done, or say even 20, 30, 40,000 contracts to be done, I'm talking extremes here, you can break it up, right? Fine. Break it up into 1,000 here, 1,000 here, 1,000 here, 1,000 here, 40 times in the day. Are you going to be able to hide that off the volume profile? No, you're not. At the end of the day, the volume profile, whether it builds one contract at a time or whether all 40,000 go on, at the end of the period or throughout the period, is going to be there. So that's my point, is that, who cares what it is? You're not going to know. It's split up into so many component parts. All you've got to know is that they're there. That's what the VWAP helps you with. And, you better know that they're there. Otherwise, you're going to be in big trouble. So, and I keep saying it, and I apologize for laboring the point, but it's really important because I just don't want people getting obsessed. I keep seeing it with, I need to figure out who it is. I'm telling you bluntly, I couldn't care less. All I want to know are some of these guys in the market. So, we've talked up to asset managers. Hedge funds are pretty much the same as asset managers, but they have a much broader spectrum of investments that they are allowed to do in terms of the sort of terms and conditions that they have with their investors. But yeah, so they'll just have a more broader spectrum of investments they'll be doing, maybe more funky stuff than what asset managers are doing. Asset managers will typically be quite, I say basic, but not basic in the sense it's easy. There might be some asset managers watching this. I'm not saying that at all. It's an incredibly difficult job. I know, to generate alpha, very, very difficult, and requires an incredible amount of skill to read fundamental research and really have a good clue of where intrinsic value is and whether you're away from that and whether there's opportunities and all that stuff. I get it. I'm just saying, in terms of actually on paper, in terms of the underlying strategy, the way you can describe it does tend to be a little bit more basic than the hedge funds, who tend to have a more broad spectrum of types of investments. That's all. Then you get swing traders, and actually, a lot of these guys will be swing traders. I just wanted to obviously put them separately because my point is that, you and I, typically we're day traders. I don't really like to use that word, but, we're locals, we're day traders, we're guys that are trying to take maximum the daily range or a part of the daily range. We're not, these swing traders can typically be entering swings for 3 or 4 days. So they'll be using things like weekly VWAP. Here is monthly VWAP. So actually it's led us on nicely. And then in this region, you've typically got quarterly and yearly VWAP. Okay, guys, this is not an exact sort of science or anything to it. It's very broad. These markets are incredibly complex. There's going to be so much overlap between all of these. There might be some hedge funds doing HFT stuff. There might be, asset managers doing different types of strategies. There might be hedgers that are short term. We already talked about it. There's going to be lots of overlap. I'm just trying to give you a rough idea of just how incredibly complex this stuff is and why there's so many different types of people with perceptions of value. Whereas I come back to the initial example, when we go and buy eggs, we don't have this problem. You don't have, all these tens, if not hundreds of different classes of investors arguing over what that egg price should be. Can you imagine trying to figure out what the price of that thing would be? Be all over the place, anywhere between £1, £5, £3. Your VWAP of eggs might tell you it's £1. Who cares? The other guy's VWAP is telling him it's £3, right? It's all over the place. Your job is to, obviously, as I said, look for these confluences. Again, I use it very carefully because I've heard confluence talked about as trend line, fib, moving average. You're going to hear it, my favorite word, utter garbage. Never heard so much garbage in my life. This is proper confluence. So you are looking for pockets of value. That's what I prefer to call it, where everything does align, or it might be, this sort of order flow here. So what it is, right? So we've, let me just finish this. I've got swing traders, day traders, as I said, the locals, and then you've got the HFTs that we've talked about, literally transacting, who knows, thousands of times a minute, right? And obviously those can be employed by hedge funds, investment banks, and then pure HFT houses. But my point is this. So coming back to what I was saying, either it could be that you're looking for pockets of value where you can go with these guys, or as I'll show you later, they could be going to like 2 standard deviation moves on their investment horizon, and that's when you can fade it on a rotational play in your sort of thing. But my point is this guy's order flow, 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 this guy's order flow. It could all be happening at the same time. All right, that's the challenge that you face going forward. Now, clearly, I've shown it quite clearly. I make money, so it's possible. All right, so you can do it. My only point is, you can only do it if you acknowledge that this order flow, all of these people's order flow, it's all going on, right? And therefore, it brings me to my final point. Who's using the depth of market footprint order flow tools? Probably just these guys. Okay, dome footprint, and then obviously to some extent, cumulative delta probably does help us a little bit with swing trading, obviously, as well, because I showed you the cumulative delta. You can obviously look a little bit wider. Guys, I know loads of people, myself included, who've tried cumulative delta on a longer than a day basis, like looking at cumulative delta for the week. It's crap. It's rubbish. It doesn't work. You're more than welcome to try it. You can look at, because I know there might be someone out there who's thinking, oh, can't I use cumulative delta for the week? Nah, it's rubbish. What happens is because the markets are resetting every day, it's not great. Obviously, I've got my theories behind it. You can never tell, but every day you got new investors. Slightly composition of investors is changing, and incredibly dynamic and complex market, as I've shown. Very, very difficult. And this comes really to the whole point of the pro section. This is why I think I'm much more consistent and successful than, obviously I keep saying it, but it's true. I was consistent and I have been consistent throughout my career, but really it's reached new heights since I've started employing all the VWAPs, looking at what is the VWAP on a quarterly. It's just a dome. it is the dome, but it's looking at order flow from a very much higher perspective. That's all. But when I say the dome here, I actually mean microscopic order flow that I showed you in the foundation course, and the footprint and stuff. Guys, these guys aren't using that stuff. You know, you're kidding yourself if you think they are. They're not. An asset manager couldn't care less, in my opinion. A hedger, right? Oil producer. You think he's looking at the depth of market? Don't care less. You've got to understand, if he wants to throw, 1,000, 2, 3, 4, 5,000 contracts at the market, 10,000, 20,000 contracts at the market, he isn't going to be looking at the depth of market. He's going to be obviously looking maybe at perception of value on a much broader scale, which is captured very well by things like obviously high time frame VWAPs, asset managers, hedge funds, global macro. Guys, I know for a fact they're looking at VWAP. Already said it. What is the VWAP? It's just average. It's the most powerful descriptive statistic in the world. Obviously, they're looking at it. They want to know, on average, where have we been the last month? Are we above value or below value? Can you see that? VWAP is universal. Talked about it already. Everyone's looking at it. All of these guys are looking at it. The difference is obviously these guys will be combining it with fundamentals, as I talked about the fundamentals. But they're looking at it, all right? It's just down here, obviously volume as a percentage of what you look at. When you come to HFTs, it's pretty much 100% volume. Day traders is like probably, the majority of it is volume. As you've seen, the way I trade is pretty much volume. As you start getting to swing trading, hedge funds on a longer term basis, asset managers, that fundamentals component, do you see it's all tying in now to what I was talking about on the triangle, where I said the fundamentals only matters after what? 3, 4, 5 days. When you can start to dampen the volatility of individual news releases and actually start to make sense of, what's the data telling me over the last week or two? That's why these guys will look at order flow, but also that stuff. This is why I moved away from depth of market, footprint. I recognize this. It was all obviously because, I've said the HFTs and obviously the algos have become probably, I've read various statistics, anywhere between 60 and 80%. That much of the market is, at least on the microscopic basis, in terms of the sort of microscopic order flow, is these guys. It's good. They're providing liquidity to the market. I got no problem with it. But these guys, so again, they're stepping in and out of the market every day, right? So this is really the final point. Every day they're trading. A lot of these strategies, not trading every day. They're trading when, they might have, say they're using monthly VWAP. Guys, the market might be imbalanced above monthly VWAP, right? Like this. Imbalance, slow trend. Okay? We could be here at the start of, I'm making this up, January. It might not be the second or third week of January before we get an opportunity for them to buy. Do you see what I mean? You got to be aware at this stage. All of this stage, as it's pulling back, whatever, you can have your, your quiet days and your, whatever you want to call it, your reversion plays and your nice little CVA plays or whatever. But when it pulls back here, OTF's in the market, Delta's going up, you need to be aware. All right? That's why we're going to bring this stuff in. So so you're not caught blinded, right? When I do my thesis in the morning, I'm thinking, is OTF in the market? That's the only name I give pretty much this whole section, okay? I'm not going to waste my time. If you want to think about, is it a hedger, is it asset manager, is it hedge fund, is it real money? That's your choice. I can't stop you. I'm not going to do that. And if you ask me, I'm going to be honest with you and say, do you know what? I don't know. I don't know. Like I said, you think these guys are sitting there saying, yeah, here you go, market. Here's 10,000, 20,000 contracts. We talked about it already, with the absorption and the games and all of that stuff. These guys are very sophisticated. They're getting, investment banks and whoever else to employ, the algorithms to spray the market with their orders over the day. Obviously, try and get execution at average VWAP and all that type. You're never gonna know. And at the end of the day, what if they're all in the market at the same time? Are you gonna be able to pick apart that? Do you see? It's just you're really going down a dangerous place. Trying to even think about that. Just think in your mind are the big guys in the market today, the OTF, the guys who multi-day, right? We're in our little part of the world, they're in theirs. When they all come in together, we need to be aware. But yeah, just remember that it is going to get quite complex now. And the reason I'm going on and on about this is because I really want you to sort of, I don't know if it's the right word, but I think it is. I want you to approach the challenge that you've got with the respect it deserves, because a lot of people, I hear them talking about, oh, it's easy, the market's easy, this technical and that technical, and can you see how far away from the truth they are? Can you imagine you've got real money, hedgers with one perception of value, real money, with a different perception of value. You've got asset managers with a different perception of value. You've got hedge funds with different perceptions of value. Swing traders with different perceptions of value. You've got you with a different perception of value. You've got all these HFTs. They've all got, at times, wildly different perceptions of where they think this market's going to go. And therefore, it's going to drive the decision of whether they think it's good value right now. It's going to be wildly different. There's times when all these things do come together. That's why we use all the VWAPs, because like I said, they'll also be using VWAP profile to make investment decisions. But I can guarantee you, these guys are not looking at the day VWAP. Some of these guys are going to be looking at monthly VWAP. Real money, they're going to literally be looking at the average price and the standard deviation, of course, over quarters. For the last quarter, where was the VWAP? For the last year, where's the VWAP? Is there value relative to the last year's sort of average distribution of prices? Is this a good time to get in? Right? Makes sense. What else can they look at? Obviously, in conjunction with the fundamentals, nothing. So that's what I'm saying. Get to know what all this stuff's, how their perception of value is, and where it is in conjunction with yours. Bring it all together. And that's what we're going to do next. So let's crack on. Hope that was useful to you. Any questions, obviously, let me know. But otherwise, let's crack on now, guys, and do the final bit. And we're going to start with, obviously, the next VWAP, which is the weekly. And then once we've done that, I'm just going to bring them all in together.